Welcome, investors. This is the REI Club. Today, our guest is Jeff Baker, and he's going to be speaking to us about real estate debt funds. So, Jeff, I'll turn it over to you.
Okay, thank you. And first off, I apologize to everybody for the technical difficulties in getting access here. So, I feel like I need to talk even more quickly to get through this, and hopefully leave a little time for questions. Once again, my name is Jeff Baker, and I'm with a company called Sortis. I'll do a brief intro. Our attorneys require that we always have the disclaimers. This presentation is not a solicitation. If anybody was to ever be interested in any of our funds, they would need to read our private placement memorandums, all of our materials. I don't think I'll be talking about any projections, but if anything comes up along those lines, you can't rely on forward-looking statements. And then also, past performance is never an indication of future results. So my attorneys are happy that we've said those things. Today, I'm going to cover a few things. I'll talk a little bit about myself and my company and just who we are, just so you have a little bit of background on that. We're going to spend the lion's share of our time talking about a debt fund. What are they? And then I'll give you a little bit of a peek into why they exist, the opportunities out there. We need to talk a little bit about risk and mitigating risk. I think tax structure is important for you to understand a little bit about. And then I thought I'd just cover a couple of portfolio loans that our real estate debt fund does, just to give you a flavor for the type of things that you might see in a fund out there. And hopefully we have a little time for questions. All right, so here we go. So myself, I'm an Oregon guy, born and raised in Oregon, went to Oregon State. I came out in 1995 with a degree in accounting. I became a CPA. I jumped into a small local firm and I worked there for a number of years, and then I went to KPMG for a time. And most of my focus in my public accounting career was around banks. And so I worked with a lot of bank clients and their financial statements. And then in 2005, I joined a local community bank out of Gresham called M-Bank. I became their CFO. And I sat in that position, in that chair. Life was great in 2005. 2007 and 8 hit, and the Great Recession started, and life was horrific in a bank. And our bank, like many, struggled mightily. We were a commercial lender. We did a lot of real estate loans. And there were a lot of challenges in that recession. And many of you may remember a lot of banks failed. A lot of my peers and counterparts went down around me, and it was kind of a tough time. During that tough time, the regulators made us fire our CEO, and someone had to be a scapegoat. And no one in their right mind wanted to step into the role of a bank that was probably about to be closed by the regulators. And so I got tapped. I became the CEO of the bank. And then fortunately, I made some good decisions, one of which was hiring my current partners today to come in and really bring an outside level of expertise on fixing problems inside our bank's loan portfolio. And so together we worked through foreclosing every type of asset and loan that you can imagine, foreclosed real estate, selling it. In certain cases, we had to build out stuff prior to getting it sold. And so we worked through that portfolio, got that bank back onto good footing, and then promptly a larger bank, Riverview out of Vancouver, decided that they wanted to buy us. And so in 2017, we sold the bank to Riverview. I'd had about a year to work on that transaction, and working with my current partners, we had fixed the bank. We were kind of bummed that, hey, this bank that we just built and are running is getting sold, so what are we going to do next? And so we went to all of our shareholders and we said, hey, we're going to migrate from being a bank lender into a private lender, and we're going to start a handful of funds, and we're going to raise capital from investors, and we're going to put that money to work in loans. And that really was the genesis and the start of Sortis. It's really an ex-bank holding company, and myself being an ex-banker, doing lending for a lot of years with that hat on, migrating into the private finance business. And so you'll probably see in debt funds, a lot of people, they have background in lending and real estate of some sort, and that's kind of how they get to where they're at when they're starting a debt fund. So Sortis, the company we are today, it's ex-bank holding company. We've been around for 6 years under this name. We started a debt fund called the Sortis Income Fund. That's our real estate lending fund. It's our largest fund. It started at $0, and today it's $160 million with about 850 investors. Pick it up. We started several other funds. We run 3 opportunity zone funds. We have a small REIT, a real estate investment trust, and then we also have a small private equity closed-end fund, rescue fund, we call it. These funds collectively, we probably are $200 million under management, and with that, we were required to be licensed with the SEC as a RIA, a registered investment advisor. So that's a little bit about us and our background in terms of who we are. Okay, debt funds, and I apologize in advance. I just feel like there's a lot of technical stuff that I want you to understand what a debt fund is and some of the stuff around a debt fund that you should be thinking about if you decide you ever want to invest in one. And really, this is just fundamentally, would you rather go out and make a loan on a piece of real estate yourself with your investment money, or do you want to pay somebody else to, or do you want to invest in someone else that does it? So a debt fund really is just taking in money from folks, and then they go put it to work in loans. They're going to pass through the lion's share of what they earn to the investor, and then they're going to clip a little bit of management fee. They got to pay their salaries and their staff and all of that. And so it's not that complex, but within these funds, there's a lot of stuff that you may or may not want, should be aware of. First off, a lot of debt funds are what they call a Reg D private placement. A Reg D was the SEC said, hey, we're going to allow some of these sponsors to come out with these funds. They're not going to be these full-blown SEC offerings. They're not going to cost $200,000, $300,000 to put together. We're going to let these folks put together what they call a private placement memorandum that talks about what the fund does and a little bit about risk. And it's really built for smaller groups to create funds that investors can invest in. So Reg D really accommodated that. There's 2 flavors in Reg D. There's what they call a 506B and C. A 506B fund and C fund, they're very similar. They both ultimately want or allow for what is called an accredited investor. And an accredited investor is, this is, to be honest, it's terrible. The SEC said, hey, we're going to decide that people assessing risk and investing in these Reg D private placement funds, they either have to make a certain amount of money annually, or they have to have a certain net worth. Their version of saying rich people are smarter, effectively, which is a shame. But nevertheless, it's the hand we're dealt, the rules we get to deal with. So an accredited investor is someone who, if you're an individual filing single, you have to make $200,000 for the last 2 years. If you're married filing joint, you have to make $300,000 a year for the last 2 years. That would qualify you as an accredited investor. The second criteria, that it's an either or, you can also qualify if you have $1 million net worth, and that excludes your primary home equity. So, a lot of people plow money into their house and they've got equity in their home, but you don't get to count that as part of your net worth per the SEC's definition. You're supposed to have, assets minus liabilities of over $1 million from other sources. So if you hit one of those 2 criteria, you are accredited and you can be in the fund. There's services out there that will do an accreditation. They grab your tax returns and they issue you a letter. It's good for 90 days. And then you can invest in debt funds like ours and like others that all require, for the most part, accreditation. You may run into something where you see qualified investors. That's another SEC level. Some funds are restricted to that, and that really requires a $5 million investment portfolio. So those terms, accredited and qualified, you may run across in your looking at funds out there. Okay, so funds can be open-ended or closed-ended. An open-ended fund is like a mutual fund. People can invest in it, they can own it, they can decide when they want to sell it, and so it just continues on and on. A closed-end fund is a fund where a sponsor would raise money for a period of time, usually 1 to 2 years. They would track down a bunch of money, and then they would close the investment, and then they would put that money to work, buying something, investing in something, and that money is generally locked up for anywhere from 3 to 5 years generally. And so at the end of that period, they're going to sell whatever they invested in, and then they're going to return all that principal and the earnings that they've accumulated to the investor. And so a closed-end fund has just a limited capital raising period and then a longer term, generally a longer term hold. So you're less able to get out of a closed-ended fund. They're not liquid. You got to be prepared to sit there for 3 to 5 years while an investment is running its course. A lot of funds will often accept IRA funds in addition to just taxable investments. And so there's a whole discussion that could be had around IRA funds. You may run into some of these debt funds that won't take IRA funds. And the reason for that is that IRA funds, when you have a debt fund, you have to limit it to really 25% of your money can come from IRA sources. Otherwise, you trigger a bunch of compliance and brain damage related to ERISA and additional reporting. And so all these debt funds, if they decide to take IRA, they'll cap it at about 25% of their fundraise can come from IRAs. You'll see IRAs sometimes, IRAs can invest in our debt fund, for example. You're going to have debt funds, the open-ended variety. We talked about closed-ended, or your money is locked up for a period, and we said 3 to 5 years. In an open-ended fund, you generally have an initial lockup, meaning you put your money in the fund and they're going to say, hey, you can't take your money out, you can't redeem out for 1 to 2 years. You're going to leave it in the fund. Our fund, for what it's worth, is a 6-month lockup. We went with a little lighter lockup period, and that's just due to kind of our approach. So I'm seeing in the comments here something, if people don't have a Google account, they aren't seeing the slides. Is that an issue we're running into, where the slides aren't visible? And if so, I guess all the stuff I'm covering, so I can make these slides available in some way, shape, or form to folks at the end. But I'm really just covering bullet points from all of these slides.
Jeff, this is Ashish. I just put that in for folks who couldn't see the slides. I think most people that have a Google account can see it. And if you don't have a Google account, I was suggesting logging in through a computer instead of a phone.
Please let me know if you're in that situation. I want to make sure that nobody's in that situation. So just type in the chat if you are, or email me.
Okay. All right, so I'm just going to continue. I'll plow along, and once again, these slides will be available, and really they're all just bullet points of stuff I'm talking about. So yeah, hopefully not anything you have to see particularly. So anyway, we were talking about liquidity. So open-ended funds are going to lock up your money for probably 1 to 2 years, then they may allow redemption. And the reason for this lockup is the investment sponsors taking your money and they're putting it into some investment. In a real estate debt fund, they're making real estate loans with that. Well, that money is getting lent out to borrowers, and those borrowers are going to pay interest on that money, and then they're going to mature, and those loans will get paid back. Well, that money's not available. There's no liquidity, if you will, to just turn around and redeem out an investor who wants to get out, if you will. They're subject to not only an initial lockup period, but you have to have loans mature in a debt fund for there to be the creation of liquidity to redeem somebody. So the reason for these lockups is partially hey, you got to commit to stay here because we're going to use your money and we're going to put it to work, and it's going to be locked up in a loan for a period of time. And then after that, you may have some other folks that, or some other needs to get out, but it really is going to be contingent on the liquidity due to loan maturities. Most debt funds usually have a minimum investment amount. I would say 50,000 is the most common minimum. Maybe you'll see a 25,000 minimum in some debt funds out there. And then many debt funds will jump up to 100, 200, 250 minimum. It just depends on the investment sponsor's appetite. If you have one investor at 250,000, it's a little easier administratively to deal with that than 5 people that are investing 50,000. But you become more, there's less people that might meet a minimum requirement versus if you have that a little bit lower. So that just depends on the fund's appetite and its capital raising profile. Most debt funds are going to provide monthly or quarterly cash flow. And so once again, your money is coming in, it's being put out into a loan. A loan is going to produce monthly interest income that's going to come to the fund. And it has the ability then to put a big portion of that back out to the investor base. Monthly is a little tough. It's just a lot of work to manage, ACHs and wires and checks to your investor database. Do a quarterly distribution of our cash flow, and that seems to work a little bit better in terms of the time and energy it takes to actually move money from our fund into, in our case, 850 different accounts on a quarterly basis. Most funds do an investment option to reinvest. They call that a DRIP program, a dividend reinvestment program. So maybe you want the earnings on a quarterly basis, maybe you don't need them, and maybe you want to keep them in your investment and just increase your investment. And so most funds will allow you to either elect to take your earnings or reinvest them. All of us debt funds are going to focus on one of two areas generally. We're either going to be more residential lenders, so on homes, or we're going to be more focused on commercial real estate, so non-residential lending. Our particular fund, we're more on the commercial side. The history, I'd say, in the last 7 years, if you go back 5 or 6 years ago, there was a great market for contractors and even individuals to buy these beat up homes. They'd go get a hard money loan or private loan from someone like us, and then they would rehab that property, and then they would sell it and they'd make a profit. You see this on HGTV, in different programs where people are doing that. It's becoming harder and harder to find homes. The prices have gone up so much that you can find and buy at a good value. And also more and more people in this world want to put money into the space. Even Wall Street's trying to get into lending money out to people that want to do these fix and flips on these residential homes. And the impact of that is that the money being lent is lent at lower and lower interest rates, where we used to be able to lend at 10 to 12%. Now it's down to 8 or 9%. And if you're going to have a lower interest rate on the loans to the borrowers, you're going to have a lower yield to your investors as that money passes through. And so many of us migrated away from residential and moved towards commercial. In our particular case, we like commercial just because there's a lot fewer players in commercial real estate. It's more complex. It requires experience to be able to figure out how to do a loan with, say a property that's got tenants that may have some tax credits. Just got some complexities that you need a little bit more background. It's a lot easier to lend on a house that you can get an appraisal on, if you will. Most debt funds in this world are probably going to target a yield, I'm going to say somewhere in the 6 to 10% range to investors. So once again, the basic performance of a debt fund, they're going to take investor money, they're going to lend it out, they're going to earn interest income, some origination points on those loans. They're going to chop off a management fee to pay themselves, and the rest of it's going to go to investors. And that's going to be winding up in the 6 to 10% range, I would say, with the residential focused debt funds being at the lower end of the range and commercial being a little higher. Our particular fund, the Sortis Income Funds, we've happened to deliver just shy of, I think it's 9.8% over the last 6 years life to date. And it's just a function of how the investment sponsor operates and how much they decide to pass through to the investor versus keep for themselves. Wanted to talk a little bit about fee structure in a fund. And so an open-ended fund like ours, it's very common where the manager that's running the fund, they're going to charge what they call an AUM fee, an asset under management fee. So as the fund grows in size, both capital coming in from investors and all that money is getting deployed out in loans, as it grows in size, the fee is just a fixed rate of the size. And so a portion of the fee may be what they call an AUM fee, just the size of the fund. And then the other portion you commonly see is some sort of performance metric, like a percentage of income. So if the fund is doing, if the loans being made are great and the fund is doing really well, both the manager and the investor are in complete alignment, where the better the yield is for the investor, the better the management fee from that portion is for the manager. And so you'll commonly see a performance-based metric on funds and open-ended funds. Some funds, in our particular fund, we take a percentage AUM and a percentage of the net income, and it's just that simple. Other funds you might see where they offer first a preferred return to the investor. They say, hey, of all the money we make, we're going to give 6% first off to the investor base, and then any money we make over that, we're going to share. The investor is going to get some of that, and the manager is going to get some of that. And so you might wind up at the same place as a different structure, but you may see something structured like that where the first amount of money goes to the investor, and then there's a sharing, if you will, between the manager and the investor on some excess earnings, if you will. Closed-end funds are a little bit different. On a closed-end fund, this is once again where you put your money in, it's locked up for a period of time. You oftentimes don't see as much cash flow during the life of the fund. Most of your profitability is going to be coming from the selling of that asset at the end of the fund's life. And the sponsor is going to figure out an IRR, a yield for you, and say, hey, you're entitled to say 6-7% of the earnings first and foremost. Anything that gives you a yield from effectively 6 to 10%, maybe you the investor, we the manager get 20% of that, and then say another thing over 10%, the manager is going to take 50% of those earnings, and the investor is going to get 50%. That's what they refer to as, people talk about these hurdles. They call that a waterfall, where the investor gets a certain amount, and then there starts to be a split until you hit the next hurdle, and then there's a different split. And so you may see some closed-end funds with a fee structure like that, where it's effectively sharing of the investment based on how well it does, if you will.
Hey, Jeff, we've got a question. So Glenn is asking, relative to the order of liquidation, where do the funds align in the stack? Is it preferred debt, common debt? What's the order of what's the order of payment?
Yeah. So that, is my next bullet point on my slide. We lend at 50 to 80% LTV. So most debt funds are generally going to be first position real estate loans, meaning they're first in the capital stack. Debt comes before equity, preferred equity comes before common equity. But in just a true vanilla debt fund, we're generally going to be first position real estate debt, meaning we're first in the capital stack. You'll start to get into some more interesting funds where you'll have people that'll take second positions. You may have a fund, it may or may not be called a debt fund when it starts taking preferred equity, maybe convertible. It starts to be more equity as opposed to debt. But in what we're talking about today from a debt standpoint, we're generally all going to be focused on being first position real estate loans. So very first in the capital stack, if that makes sense. And so to that point, debt funds generally are focused on principal protection. They're not a stock. They're not going to double in value. They're going to make loans on real estate, and they're going to get an interest rate. Doesn't have the ability to go up or down for that matter. It's just going to be fixed at that rate. And so the yield that you're going to get from a debt fund is going to be somewhat consistent. If the debt fund has a lot of problems and they make a bunch of terrible loans, yeah, you can have a disruption to your yield. But even if the debt fund does really, really well and real estate values are going up, you're not going to make any more money in a debt fund. You're really making money from these loans, and that interest rate is generally fixed. So you've got real downside protection, but you got somewhat of a consistent cash flow return in terms of how these funds are designed. Specifically, they're going to lend, I say, 50 to 80% loan to value. LTV is loan to value. So if you have a property worth $1 million, a fund like ours, we happen to be in the 60-65% loan to value range. That means we'll lend $650,000 on $1 million property, and we're going to collect interest on that $650,000. And if that borrower stops paying us, we're going to come at them, take that asset from them, and we're going to blow it out. $1 million property, we'll blow it out for $900,000, and we'll recover all of our $650,000 principal, our back interest, any collection costs and the like. And so a debt fund is in first position, and it's going to just lend a percentage of real estate collateral. So it's got a fair amount of protection in case the loan becomes non-performing. I wanted to talk about leverage versus unlevered. Just, you need to understand this if you're investing in debt funds. And so leverage is just really another name for borrowing. So if in our particular fund, we're unlevered. We do not believe in borrowing money. In a levered fund, what happens is you raise money from your investors. You have a certain amount in your fund, and then you put that out to work in loans. And then you may go to a bank and you may say, hey, bank, would you lend me some additional money for my fund so it's bigger? And in exchange for that, bank, I'm going to put this loan portfolio, I'm going to pledge it to you, the bank. And so you now are the most protected, and the rest of my investors are behind you in terms of protection, on your investment money versus your debt. And the reason you would do that is the bank is going to lend you money at, say, 5%, and then you get to use all that money and you get to go lend it out at 10, 12%. And you get to make more income for the fund, and you hopefully are distributing that to the investors, and they're making more money. Some managers, clip some of that in additional management fees. So leverage allows you to do better in good times. The downside is, say you run into a really bad economic cycle, and the bank says, you know what, you've blown a loan covenant, something's out of whack, and I want all my money back. And then you're stuck as a fund, and you have to somehow get them all of their money back, meaning you may have to liquidate some loans, you may have to sell some things, and sometimes that can happen in discounts. And if you're in a really bad cycle, that's usually when the leverage unwinds, when the lender wants their money back. It can result in ultimate losses to the investor. And so there's a real downside. And so if you're talking to a fund, you need to understand if they're levered, meaning they've borrowed money, or if they're unlevered, they just have investor money that they're putting to work. The unlevered funds are the least risky, but technically they probably don't have as much ability to deliver a higher yield to their investor base. We're an unlevered fund. We're at the top end of the yield range, but that's just, I guess, a story for another time. Let's see. A lot of people invest in debt funds because they're counter-cyclical. So the real estate values don't necessarily behave with the stock market. So, there's a school of thought out there that you should have some money in the market. You should have some money in bonds, fixed income, something a little bit more stable than the stock market. And then maybe you should have some money in what they call alternative assets, maybe real estate being one of those, where your investment in a debt fund like ours, it's going to, even though the market's in the tank and, going up and down and volatile, we and others have been marching along, delivering a steady return based on what we do. And so you're not necessarily going to see a yield fluctuation with the market. And then the final thought that I had, at least on debt funds to share, we made the fund itself, small or large, may be on various investment platforms. Our fund, for example, is on Schwab and TD Ameritrade. So if you have a Schwab account, you can invest in our fund. And when we produce earnings, we communicate back to Schwab. And so on your Schwab statement, you could say, hey, I've got this $50,000 investment in Sortis income fund. I can see my quarterly earnings. If I added on some funds, it shows up in my statement. If we're not on the platform, then you would have to take your money, it would leave Schwab just like it would anyway, and then you would just get a statement directly from us. And so we would show you your investment statement. Hey, here's the $50,000 you gave us. Here's how much earnings you had. You just wouldn't get to see it all in your Schwab statement, if you will. And so you may or may not be able to invest based on the fund and what platform it's on. A fund has to be on a platform if it's an IRA investment. You have an IRA, they're only going to allow you to invest in things that ultimately are on their platform. And so that can be a limiting factor on the size of the fund. Okay, let's see.
Jeff, we got a question here from Ashish. He's asking, how will higher interest rates impact returns?
Yeah, so interest rates are an interesting thing. Interest rates, are set by the Fed, and they really affect bank lending rates. And so banks are lending at higher interest rates than they were previously, right? So us private lenders, we have your investor money. You're invested with us, and so we have to return a yield to you. And really, investors' expectations aren't changing. If I'm giving you a 10% return despite interest rates going up, people still expect or would like a 10% return. Their yield expectation relative to rising bank rates, doesn't change. And then similarly, we really respond to what are other private lenders doing? Are they lending at higher interest rates now? Not really. I mean, we always have been lending in the 10 to 12% range. And even though bank rates are creeping up, it hasn't really allowed us in the marketplace to raise our rates, with our borrowers. They still, if I raised my rates, then they probably could go to someone else who didn't raise their rates. And so really it's our competition that determines the rates we will be able to charge, and ultimately the yields we're able to deliver to our investors. So we're not moving up and down with the Fed interest rate changes. The market, the hard money or private financing market is somewhat static in terms of the rates they charge today. What I would say, the rising interest rates is great for us and private financing, because people, there's less of a difference between the bank rate and our hard money rate, if you will, and so that's helpful. Some of the levered competitors, their cost of funds are rising. This environment with the raising interest rates has banks tightening their commercial real estate lending, and so we are seeing routinely more and more demand for loans that need a home. And so in this type of a market, we're inundated with requests for loans, which is great. And once again, this is part of the counter-cyclical nature. When we're in a tough economic cycle, COVID, this current recession that we're in, it's great for private lenders like us. We see an uptick in demand where people need to borrow money to get stuff done because their other sources are tightening, if you will.
Hey, Jeff, just to let you know, we've got 10 minutes left, and maybe you're going to get to this, but do you have a profile for the typical property that you lend on?
Sure. Yeah. Okay, I'll speed up. So real quickly, we've touched on this. Really, us debt funds exist because we're quick. We can show up in 2 weeks and help a deal get done. We lend short-term. Banks want to do long-term loans, and that's something that just doesn't work inside of a bank, if you will. So there's a huge demand. More than 50% of this country's financing are happening through the private market, through traditional banks these days. Investment strategy. This is just really, hey, you should have some experienced people doing stuff because you're lending, you're assessing real estate assets, and you're lending on them, and you're working with borrowers. And if you have to go at them and collect on that real estate, you better know what you're doing. There's some information here on risk mitigation. We talked about that. We lend a percentage of the value of real estate. So even with this slide, we show a 20% decline in the value of the collateral. It's still going to be worth more than the loan we made originally at that 65% loan to value. Part of investing in a debt fund, you're investing in a large number of assets versus a single asset. We talked about leverage, liquidity. You just want to be able to lend short term, ideally, versus long term. That provides less risk, as real estate values, if they change, they're not going to change massively overnight. They're going to change a large amount over a long period of time. So if you're lending short, you definitely have a chance to exit loans long before you might see collateral values decrease. Oh boy, tax structure. We probably don't have that much time to talk about this. I just wanted to mention most debt funds have implemented what they call a subsidiary REIT strategy. Without going into too much detail, by doing this, it really allows the ultimate investor to invest in the debt fund. They only have to file their federal and their home state tax return. If you don't have a sub-REIT profile or a sub-REIT strategy, your investor in a debt fund might end up having to file in multiple states if the debt fund has collateral and loans in multiple states. So it's something you kind of want to avoid and pay attention to. And then you also get a little bit of a tax break with this REIT structure. 20% of your earnings are not taxable for federal purposes. All right, here we go. Profile stuff. So we're a commercial real estate lender, and here's the type of stuff we do. This isn't the type of stuff you as an individual are going to find to do. You could probably find a residential loan, but playing in the commercial space is a little tougher. This is a repeat borrow of ours. He owns a Stanley Hotel complex in Estes, Colorado. He had a large space that needed to be rehabbed that was pre-leased to tenants. We like pre-leased, so this isn't producing cash flow at the time, but the property value is pretty high, and we provide some money. We're going to dole it out over a period of time. He's going to rehab it, put his tenants in. Once the tenants are in and they're producing their lease income, then he'll turn around and the bank will take us out and do much lower interest financing, if you will, but they just need the underlying asset to be cash flowing from the tenants, if that makes sense. And so this is an example we're going to charge. We charge 2 points origination fee and a 12% interest rate for about a year, produces a little over a 14% yield for our fund. We'll do an occasional land loan. In this case, we did a land loan in Woodburn on a 79-lot subdivision. We would never do what they call a speculative land loan. So we lent money, we doled it out as this particular developer, they had their plans and permits, they put in streets, utilities, and they got 79 lots ready to build on. We only did this loan because it had been pre-sold to a national home builder. So the home builder had put a bunch of money down, had a contract to purchase it once it was done. Once again, we wouldn't finance this kind of a project only to have then the developer try and sell these 79 lots to residential owners that want to build homes. That would be a lot riskier of a deal, but we'll do an occasional land deal where it's pre-sold to a national home buyer. So we know where our takeout's coming from. Because it's land, we charge a little bit more. We're able to get a 20% yield for our fund on a project like this. We particularly like hotels just because we have an affiliate company. We own hotels, we run hotels with management teams. So we've got a lot of expertise in hotels. And so in our fund, when we underwrite a hotel, not only do we have a lot of people to talk to about values and hotels, but heaven forbid we have to foreclose a hotel and take it back. We got a group and a team of people that we would put in place to manage it and run it while we liquidated it. But in this particular case, this was a hotel. The pricing during COVID for hotels, hotel values went down. We had a great borrower and they were able to put a fair amount of money down. We got an attractive loan to value and they were able to buy something at a fair discount to what we thought the value was. And so this is an example of just a larger deal that we did. In our fund, we generally do loans in the 2 to 20 million range. And the last one I was going to share is kind of a new COVID product class that I think is kind of interesting, and we like doing this a lot. You've got groups of people out there that are running around the country, and they're looking for tired hotel, motel type properties. And what they're trying to do is they're trying to buy these properties. They want to convert them into what they call workforce housing. So they're looking for these properties and demographics where there's a large service industry need and there's no affordable rents for folks in terms of being able to find a place to live in that market. And so we show up, we help somebody acquire these hotel motels, oftentimes at auctions or the like. They develop their plans and their permits. They get their rehab budget figured out. Then they'll go get a construction loan from some other lender. They'll take us out. We'll be done with a project. And then with that construction loan, they'll convert this into the individual hotel rooms will become studio apartments. They have to put in a little bit bigger of a kitchen unit. But this property comes with lots of parking. It's already got a pool. It's already got a small gym. They'll convert the lobby to an office space, maybe add another amenity or two. But it works out that the cost of acquisition and the rehab is much cheaper than building this kind of product from scratch, new construction. And so there's this cottage industry that's converting these around the country in certain markets where they've got real issues with affordable rents. And so in charging an affordable rent, there's a great business model and these projects cash flow. And so this is a project, we have 2 or 3 of these on our books. And we continue to look. We have to look at the demographics and feel like they're in a good spot. And then we like to deal with borrowers that we've seen before. All right. Oh my gosh, 5 minutes, and that's all we've got left for questions. And I apologize. I hamstrung us by not being able to get in here right away. But that was a lot of information about debt funds. I'm going to make sure if anybody wants these slides, they're welcome to them. If anybody wants to talk to me a little bit more individually, I'm happy to do that. Here's my contact info if you want to track me down. But let's see. let's see.
Yeah, there's one question about fund of funds versus a debt fund, and is this a type of fund of funds? That could be a pretty involved discussion, but I'll let you answer it.
Yeah, no, it's pretty straightforward. So we have a few fund of funds that invest in us. What you see, a fund of funds means oftentimes you'll have an REI, registered investment advisor. They'll get a bunch of their clients to give them money, and they put it into a fund. And then they, in turn, will invest that fund into other stuff. And part of that stuff they invest in, it might be our debt fund, our Sortis income fund. So we do have a couple of funds that invest in our fund, and those funds that invest in us are called fund of funds. Meaning, someone may raise $100 million. They may say, you know what, I want 10% of this in the Sortis income fund, and so we have a fund that invests in our fund, as opposed to an individual directly investing with us, if that makes any sense. So a fund of funds really is just a pot of money that someone is managing. It invests in other funds, and that's just, you're oftentimes really just paying somebody to kind of diversify your money across a variety of investments. I think there was a question in here. Okay, let's just go back here.
How much of your portfolio this is Glenn again, how much of your portfolio do you sell versus carry to maturity?
100% we carry. So yeah, we're just not in the business of making and selling loans. There's something that you can do there, but we source all of our deals independently. We underwrite them. We go walk the collateral. We do custom docs with our attorneys on individual loan. We service them in-house. It's important when you assess risk of a fund. If you're investing in a fund that's buying loans from other people, they've never met the borrower. They've never seen the collateral. They don't know the history. They don't know the business plan of the borrower, how they plan to pay that off. And so I think the thing it's an important risk assessment is, are you investing in a debt fund that's just buying stuff from other people, or are you investing in a fund that has firsthand knowledge of the loan, the borrower, and kind of its performance history, if you will. So
I kind of laughed when you said I walked the collateral. I think that's the first time I've heard that phrase.
Yeah. Let's see. What's your percentage of bad debts you have to manage? This is kind of an interesting one. I would say 2-3% of our loans may wind up in a non-performing category. The funny thing is, if you take all of our non-performing loans over the last 6 years, we've actually made more money on those than had they performed. Meaning, we've got great collateral. We're going to jack them up to a default rate at 24% instead of 12%. And then when push comes to shove at the end, we're going to collect it all. And so if you do your job right, it's actually a revenue stream or a resource to have loans go into non-performing category. Unfortunately for us, we don't charge anything to our fund to manage bad debt and performance issues. We just roll up our sleeves and take care of that stuff. And our investors also make a little bit more money from that stuff collectively, I would say. Let's see, we talked about the interest rates. How will higher interest rates?
Do you want me to read the questions off to you?
Well, I think I've got them on the side here.
Okay.
I don't think there's anything there that I haven't touched on. I think in terms of the questions, unless you see something.
Well, actually, at this point, we love to take ourselves all off mute. And everybody, could you do that? And thank you, Jeff, for coming in and talking to us.
Yep.
Thanks, Jeff.
Great presentation.
Thanks, Jeff.
Thank you so much.
No,
Very informative.
Thank you.
Thank you, Jeff.
Yeah.
You got to come back. Thank you.
Yeah, happy to come back and spend more time
definitely do
at some
that.
point. Yeah,
we'll definitely do that. All right, and next week we have, I believe, Ashish Gupta, our very own, coming in presenting. So stay tuned for that. We'll be here at the same time on the same day. Have a great weekend, everyone.
Yay. Good night.
Thanks,
Thank you, Jeff.